All right, welcome. In this explainer, which comes from the work of Dr. Sadendra S.G., we're going to tackle something that's a huge part of all of our lives, but maybe we don't think about it all that much. Insurance.
So, what do they have in common? It sounds like a trick question, but I promise it's not. The answer is a really simple but totally powerful idea about how we deal with one of life's biggest headaches, uncertainty. It's all about facing the unknown together.
You know, to really get what insurance is all about, we have to start with a basic truth that every single one of us knows. Life is just, well, it's unpredictable.
Yeah, we've all been there, or at least we know someone who has. A car accident out of the blue, a sudden health scare, a natural disaster. These things are tough. And it's not just the emotional side of it, right? It's the financial shock that can absolutely devastate a family or a business. The real problem we're trying to solve here is that giant question mark hanging over our heads.
So, faced with all this randomness, what do we humans do? You might think the answer is just to be stronger or save more money on your own, but actually the real breakthrough came from working together as a community.
Just try to picture this for a second. You're a trader in ancient China. You put all of your valuable goods, everything you own, onto one single ship. I mean, the risk is incredible, right? One bad storm, one run-in with pirates, and poof, your entire livelihood is gone, sunk to the bottom of the sea, a complete and total financial wipeout. But then they had this brilliant, almost ridiculously simple idea. What if, instead of putting all your eggs in one basket, you spread your cargo out over lots of different ships? Suddenly, the whole game changes. If one ship goes down, yeah, it stings a little, but for each individual trader, it's just a small, totally manageable loss. They basically invented risk sharing on the fly.
And that right there, that idea of sharing the load, that's the heart and soul of insurance. It's just a formal system for doing what those traders did. Instead of one person getting completely crushed by a disaster, that huge weight gets spread out so thinly across a big group that everyone just carries a tiny, tiny piece of it. It's genius, really.
Okay, so that's the big picture idea. Simple enough, right? But how does that ancient concept actually work in our modern world with all its rules and regulations? Well, let's dive into the mechanics of it.
It really breaks down into 4 pretty simple steps. First, you've got something of value. We call it an asset, like your car or your house, and there's a risk something bad could happen to it. Step 2, a whole bunch of people facing that exact same risk all agree to chip in a little bit of money, what we call a premium, into one big pot. 3, an insurance company steps in to manage that big pot of money. And finally, step 4, when one of the unlucky few in that group actually suffers a big loss, the money from the pot is used to pay them back. See? It takes a huge, scary, unpredictable risk and turns it into a small, predictable cost.
Now, this brings up 2 key words you'll hear all the time: peril and risk. They sound kind of the same, but they're different. The peril is the actual thing that causes the damage: the fire, the flood, the theft. The risk is simply the chance, the probability that the peril is actually going to happen. Insurance, at its core, is a tool for managing that chance.
Let's put some real numbers to this, because this is where you see the true power of the idea. Imagine there are 10,000 people, and they're all worried about the same kind of potential loss. If every single one of those 10,000 people chips in just 2,000 rupees, you've suddenly got a fund of 2 crore rupees. That's enough to cover the expected losses for the whole group. A massive life-altering problem for one person becomes a tiny, manageable payment for everyone.
Now, you could always try to handle risk yourself, right? Just save up a big pile of cash for a rainy day. That's called risk retention or self-insurance. But let's be honest, for something huge and unpredictable, who can really save up that much? That's why insurance is the most common form of risk transfer. You are literally transferring the financial headache for that huge uncertainty over to an insurance company. In return, you just pay a small certain premium.
So we know what insurance is and how it works, but where did this idea even come from? It didn't just appear out of thin air. It turns out this concept of sharing risk has a really fascinating history that stretches back thousands of years.
I mean, we're talking way, way back, like 3000 BC, when Babylonian traders were using these clever loans to cover their shipping risks. The kind of insurance we'd recognize today really started to take shape in, of all places, a London coffee house. Seriously, merchants and ship owners would meet there to underwrite each other's voyages. Over the centuries, this evolved into a formal industry, with huge milestones right here in India, like the founding of Bombay Mutual in 1870, the nationalization that created LIC in 1956, and finally, the establishment of the IRDA to regulate the whole industry in the year 2000.
Okay, so we've got this financial tool with a long history. But so what? Beyond just paying for a fender bender, why does any of this really matter? Well, the impact insurance has on all of our society is actually way bigger than you might think.
Think of insurance as the financial bedrock of the modern economy. It protects the capital and wealth that we all work so hard to build. It removes that paralyzing fear of what if, which gives people and companies the confidence to take risks, to start a business, to buy a home, to innovate. A bank is much more willing to give a loan for a new factory if they know it's insured against disaster. It truly greases the wheels of commerce and development.
This quote just nails it, doesn't it? The whole promise of insurance is to take that huge, terrifying unknown and transform it into a manageable plan. It doesn't stop bad things from happening, of course, but what it does is provide a reliable financial backstop so that we can rebuild and move forward. That confidence, that certainty, is what allows us all to plan, to build, and to live with a little less fear.
So, from protecting ancient ships to covering modern cars, that fundamental principle of sharing risk has been unbelievably successful. But the world today is facing totally new challenges. Complex risks like global cyber threats and the growing effects of climate change. The fundamental human need to share risk is as strong as ever. But it leaves us with one final thought. How will this ancient idea have to adapt and evolve to protect us from the uncertainties of tomorrow?